be ready for more rate hikes. Like, there is at least another 100 basis points to come, if not 200 basis points going into early next year. That's why we're going to have a crash landing instead of a soft landing, because what ends up happening is they have to keep going and going and going, and eventually, like you're saying, it gets to a point where people don't have the money to pay for things, and the prices have gone so high. My thing that I think is really going to come of this is I really do believe there's going to be a freeze in immigration, because like you said, there's a supply issue. It'll perpetuate the slowdown. We'll have a slowdown next year because rates are so high, net worths are getting wiped out, and then they're going to freeze in the immigration, and then that'll continue it. So we'll have a extended slowdown from this, I think.
When I was broke, I had rich habits. When I was broke, I had rich
Welcome to
habits.
Master Keys Podcast. This is episode 43 of season 2. I'm Chandler Haliburton.
I'm Neal and Andreino.
And this is a podcast all about growing wealth through real estate and talking about everything surrounds that, covering the news. And we're landlords / realtors.
Don't sound so excited about it. We're realtors. We've sold, what, $400 million of real estate?
I think it's closer to 5, but who's
$500
counting?
million of real estate. We have around 200 units. And yeah, this podcast is designed to hopefully help you do better in the investing world if you're investing, or just have an understanding of it. And we talk about, like you said, everything about real estate, but everything that also affects real estate, because there's a lot of other items and other news items that will impact what happens with the real estate world. And it also, same with real estate, it impacts a lot of things in your life that you might not even think about.
Yeah, wealth is where you have, or real estate's where you have all your wealth. Problem is right now the government doesn't want you to have any wealth, or at least Bank of Canada wants you to have no wealth. So that's a lot of our conversation. So we're going to talk about that. Tons of rate stuff coming out. I know we've beaten that horse, but it is the most important thing going on in the market today. But we're super excited because a lot of you have asked us time and time again about private money options. So we've brought on a colleague of ours who works in that space, Ryan MacNeil with Graysbrook.
Lent me lots of money.
Yeah, it's lent Neal lots of money. And so we have a full interview with him. You definitely want to check that out. We really dive into some extra stuff with respect to private money and vendor takebacks on our Patreon. But this is a really good high-level conversation we have with Ryan. So stay tuned for that.
Yeah. So let's get into the news and get us started.
Oy, okay. Yeah, let's get into the news.
You got all the numbers. Everyone knows Chandler's got all the
we're
scary
gonna,
numbers.
Yeah, we're going to start with the inflation talk. We've got two updates. So there's what's
They're
going
not
on in
good.
the U.S. Yeah, none of it's good. It's all terrible. U.S. inflation is up, especially the core inflation was up 0.6%, and overall inflation was up 0.4%. Core inflation kind of subtracts the more volatile energy items out of the overall CPI to give what they believe is a truer reflection of inflation, and so it wasn't good.
Give us Canada numbers before I go off here.
Yeah, so Canada, the numbers just came out. So our overall CPI inflation is at 6.9, which is down from 7, so a little 0.1%. We're doing it, but our core inflation actually went up the same amount, 5.4 up from 5.3. So at best, we can call that a wash.
But that's worse than a wash in the sense that they're doing all these rate hikes, and we've been talking about how we think that they did enough rate hikes. I'm not going to say we, because I didn't agree, but they've done enough rate hikes that it's going to cool things off, and now we're seeing that it's not. And we've talked about how, listening to Tiff, they're basing their rate hikes off core inflation. So inflation went down 0.1%, which is not really proof that it's going down in any shape or form. But even worse, core inflation didn't even stay level. It's slightly notched up, which is a really, really bad sign. With the fact, and you mentioned it, gas has been going down even more. And so they're kind of artificially dropping the price of gas to try and hopefully bring these numbers in. So if you didn't have gas going down,
So what's your
core
solution?
inflation would be up. So my solution, honestly, I don't have a solution necessarily, but I'm saying more so I'm just being like, be ready for more rate hikes. And I think more aggressive rate hikes. Like, there is at least another 100 basis points to come between if not 200 basis points going into early next year.
Yeah, so the U.S. inflation numbers kind of coincided with the 75 basis point increase on their Fed rate. The next Canadian announcement is coming out shortly after this episode drops. I think the announcement's on the 26th or 27th, so somewhere in there of October. And the question is, like, right now the market is kind of pricing in a 50-point hike. Yeah. But there's some thought maybe with these numbers not being awesome, not being super
75
encouraging.
Lego.
And the Fed doing 75 points, that Bank of Canada may do 50 points as well. As you mentioned, we had Tiff here, and a couple of things that he stressed. I've got these highlights here. One, the labor market is too strong. He's saying, frankly, there's not enough job openings. However, I will say the job openings dropped in September from August, so there are less like job postings out there. But he hammered that point. He said the labor market is way too strong.
The labor market means there's too many people.
No, it means there's too many people. Like there's too little unemployment. There's too much demand for labor. Labor is too expensive.
Exactly.
Right.
Yeah,
so
yeah.
The thing you can take from that, and I've said this in an earlier segment and kind of got not flamed for it, but the reality is until people start losing their jobs, inflation is not going to come down.
Yeah.
That is the reality of how it works. Even if you want to just go real fundamental, the graphs and how they interact and normal level of unemployment and inflationary pressure and all these things, like people are going to have to suffer in their take-home paycheck. The irony is, or the problem is, and this is why it's scary when monetary policy doesn't do what it supposedly does in the model, is that you need people to have less money at the same time that inflation is going up. Like that is a problem.
Down.
Like you are putting a lot of faith in this boy Tiff turning these dials and assuming that is going to fix things while also suggesting people need to have less money.
This is why we're going to have a crash
chicken
landing.
and an egg situation, and it's dangerous.
That's why we're going to have a crash landing instead of a soft landing, because what ends up happening is they have to keep going and going and going, and eventually, like you're saying, it gets to a point where people don't have the money to pay for things, and the prices have gone so high. I'm just thinking in my head, I'm like, I'm going to be refinancing my private money into more expensive mortgages soon. Like, oh, I'm getting out of this private loan at $999 into a nice fixed term at $14.99, 5-year prime loan.
Jeez, Murphy.
The one thing actually on that note is Walmart. I'm not sure if anyone noticed. It kind of went under the radar. I don't know if we talked about it, but Walmart suggests they're going to do price freezes on all their in-house brands in June. And so they were going to say like their price fixed guarantee. They've always undercut inflation, and so they froze all their prices. In response, Loblaw has just announced, so Superstore, I forget what other brands they have, but Superstore, Atlantic Superstore, and Loblaws all have announced to freeze all the prices on their no-name brand until January 2023 to help consumers fight.
Bullshit.
Wow, this is what I said. But because my thought is, why do you think they're doing it?
It's because this is actually working. People are not buying as much. Like orders are going, are being oversupplied. Like we talked about this before. This is how these interest rates trickle through the economy. The first thing is the housing market, stops, and then orders stop, and then profits stop, and then there's job loss. So we're at the point right now where orders are slowing down. And we talked about this even months ago.
This is a marketing promo. Instead of putting things on sale to get rid of the excess inventory, they're doing this, and people are like, oh, I'm going to shop there and buy these brands because I know the prices are fixed. The other thing is they're fixing the prices at the highest point that it's been, and now there's excess inventories. And so we're supposed to be having massive sales coming into this Christmas season, but instead they're all doing this thing of like, oh, we're here to save the people.
Yeah.
We want to save the people money. We don't want you to be impacted by inflation. So what we're going to do is we're going to lock all of our prices in at the highest point they've ever been. And enjoy it, guys.
But if you want to take some optimism from that, like I think that this is because they currently are overstocked. Right, which means
eventually the prices will have to come off.
Yeah, which means they're at a point where they have over-ordered and their future orders are going to be less, which is phase 2 in the 4 trickling down components of these interest rate hikes. So this is why we're still in the midst of it. And it was really discouraging to see these numbers for September not be good, not be positive, and it doesn't bode well for other increases. But I still am optimistic that this is working its way through the economy as long as people realize that the last level of this is job loss, because that is what's going to have to happen. There is a counterpoint, like to what you're saying, which is we're turning these interest rates up and they don't seem to be doing anything. It's led some people to believe that, well, maybe this really isn't the issue. And maybe it is what you and I kind of talked about for some time, which is that this is a supply issue. This may even be a corporate gouging issue.
Well, of course, yeah.
Right? So maybe just making everyone lose all of their net worth and struggle to make their mortgage payments and have less money isn't the solution we need here. Maybe it's some other intervention, or maybe, and this is scary, there are going to be some things that are not in our control, which is reliance on trading with Eastern countries, reliance on stability in Europe and Russia for oil. Like all of these things, it turns out, are not entirely in our control. And now we eat it on pricing, and it doesn't matter what you turn the interest rates to. There's no interest rate that's going to make the conflict in Ukraine stop.
100%. I'm just, in my head, I'm thinking about, like, it's curious how we dumped all the money into the market. And I'm like, I look at how China did it, where they actually try to put in infrastructure projects. I wish we had done something like that more so than just dumping money into the market when COVID took place. My thing that I think is really going to come of this is I really do believe there's going to be a freeze in immigration because, like you said, there's a supply issue, and that's not going to get fixed any short term. And I don't just mean for housing; I mean for everything because immigrants don't just require a house; they also require all the products that go along with living. And so I think this is going to put a freeze in immigration, which, again, I don't think it'll impact us immediately, especially where Halifax had such great growth and the rest of Canada has too. And right now we have this oversupply, but eventually I think they're going to freeze it for multiple years. It'll perpetuate this slowdown. We'll have a slowdown next year because rates are so high, networks are getting wiped out, and then they're going to freeze in the immigration, and then that'll continue it. So we'll have a extended slowdown from this, I think. Like it's shaping up to be pretty bad. Like it's scary that they keep raising these things. They're artificially pushing things down. You got price freezes at Superstore and inflation still flying off the charts.
Yeah, I feel like 2023 is going to be a year like 2020 where you just kind of hope that you can just forget about it and it didn't happen. Like I think 2023 is going to be a drag. Just to highlight a couple other things that Macklem said when he was here in Halifax. He said that energy costs are being passed along to consumers. No kidding. He acknowledged that monetary policy takes time. Ironically, I would say that he's not giving it time, but he does acknowledge that it does take time. He hammered the fact that 2% was the target for inflation at all costs, effectively. So if we're now at 6.9%, and we've raised, I don't know, how many points are we up now? 300 or so? And we've managed to bring inflation down maybe like 1.3% from highs and barely adjusted the core inflation. And he's still targeting 2% at all costs. And these quotes I had was that quote number one is that there's no clear indication that underlying inflation has come down. So he's done all this, and there's no clear indication it's had any impact. But he says there is a clear indication that more increases are needed. So that is what is on the horizon.
You know, the only good thing, I'm going to give them some creds on this about the early crazy rate, the crazy rate hikes off the start versus doing like progressional forever. And this is what we're seeing. CNBC released this, but mortgage demand has dropped to a 25-year low, which is really smart that they've done this because it's tailoring people off, I think, in a really quick way, which I think will prevent a lot of people from getting in a scenario where they're over their burden, like they're over limit, they're over their capacity to borrow, and then they're going to get screwed. Because I think what happened, if it's a slow increase of rates, people would have still been borrowing. By raising this really quickly, it crushed the sentiment. It got a ton of people to slow down. They said new mortgages are down 38%, refinances are down 86% year over year. So people are just like,
yeah, I mean that's to be expected for sure. Because
it's to be expected.
You refinance right now, like unless you absolutely had to, you wouldn't.
Of course, but my point is that if they hadn't have done it in this manner of increasing rates at an expedited, like in a super fast pace, then this wouldn't have happened. People wouldn't have slowed down as much. People saw like, oh, they're going up by 25 basis points each time. I'm going to crush in all these refinances, maximize as much money as I can get out of it, and then be in a situation that they're screwed. So by doing these really quick rate hikes, I think it actually cooled the market for that side of things, which is really good. Like I think they're helping consumers protect themselves.
I'm gonna throw out something at you, and I'm really curious to get your thoughts on it because it really got me thinking. Canadian prices were down in September, I think 1.4% across the board, which now we're down about 14% from the ultimate high in March.
Yeah.
Right? So we gave back essentially all the gains that were made in the first quarter.
Yeah.
And we did a breakdown in a previous episode how that really is skewed towards some of the periphery areas of Vancouver and Toronto. And in fact, in Toronto, like there's some pricing stuff in Toronto that there's still something like 25 to 40% of homes are still selling over ask in the core of Toronto. So there's some nuance in that 14%. That 14% very likely does not apply to the place you're listening to. It certainly doesn't apply to here in Halifax. We've given back quite a bit of the game, but not that amount. Regardless, a couple interesting things that are going on. One is that there is some chatter about lessening the stress test, because right now for someone to get approved for a mortgage, they're getting stress tested around 7.5%.
Yep.
Right, because remember what they do is they take the rate and then they add 2 points. So you can imagine how hard it is for someone to qualify at 7.5%. And there's some talk that they're going to lessen that, which is ironic because the whole point the stress test is in there was to protect buyers in a situation like we find ourselves now, where they purchased a property at one rate and they may be coming up for renewal, or they're on a variable product and it's much higher. The stress test was there to protect them, to ensure that they could still carry that debt. And now there's some chatter about lessening that test
Bad idea.
to allow people to qualify.
Bad idea.
Here's another one.
That's a bad idea. Can I say what's a bad
Okay,
idea?
yeah.
So my opinion on why that's a bad idea, and this is again where I think there's an unfound like trust in the banks, and everyone just assumes that they're like the know-all and they are a safe place, but they are just a business like everybody else, and all of the people within there are trying to make their best guesses on where things are going. And I think that came around because there was a sentiment that the rates would not continue to increase that much more. Like a few months ago, everyone was like, we're near the end of it. They're going to cool these bad boys off. We're going to level it out. Things are going to be great. By the end of next year, we're all going to be dandy roses. Now they're all like, oh, shit. So I think that's when that came up, because they're like, well, realistically, rates aren't going to go another 200 points or more. So we can start cooling this off, because realistically, that's peaking them out, and no one would ever actually have to pay an 8 or 9% rate. So I think by removing it, it's a very bad idea. And I think
So why are you saying the banks
they're
want
helping
to do
to
it?
protect people by leaving that in there. Why is the bank doing that?
Yeah.
Because they got to keep lending money out. Like
Exactly.
They need to get the money out.
mortgage
They're a
demand
business.
thing that you had.
They have mortgages to get. Like they're having like the mortgage demand is down. Like we just said, 40% for new mortgages, 86 for refis. They need to get the money out there because they're a business. They got to keep churning it over.
Yeah.
And so they want to reduce it, but they're not helping consumers. Like everyone's like, oh, this is like they're out helping me get into my house. I'm gonna get a home.
Well, this was the
yeah,
thing.
but you're also gonna have to give it back in 2 years when the rate's 9.5%.
Well, that was the thing too with like why variable was so enticing is because you were stress tested at a lower amount, like, and that's part of the reason people were incentivized to go into these variable products. At the same time as Bank of Canada was saying those rates were going to be low for 2 years and all these things, like, and then they slap our wrists like, well, you guys were overextended. It's like, well, you kind of forced us in that position. But
What's your next thing?
yeah, I think that they're definitely doing this. I bet you they're going to do something like, yeah, we'll lessen the stress test on our 5-year products.
Oh yeah, I could see that.
I can see them doing that. To
Which
try to let
I'm
people-
not too opposed to. I was gonna say I'm still for the idea if you can get into like a long-term fixed product at a rate that you're comfortable with. Maybe not 5 years. I think it's a little aggressive, but even if you took a 5-year and you're like, I can make this payment, and I'm comfortable like with what I have and all that, I don't think that's a bad idea. I would be nervous if you're squeaking into a property on a whatchamacallit, on a floating rate right now.
Yeah.
You're just squeaking in on a floating rate. Like that means you're just being able to do it, and that's how they're qualifying you.
Well,
and
at the end of this
now
month,
that's going to keep going up, and like that's where you're going to get screwed.
at the end of this month, the variable will be higher than the fixed anyway.
That's see?
Like it will be, I think, effective with this next rate hike. So no one will be taking variable money if it's a qualifying issue. If it's a qualifying issue, they'll be taking the fixed money. I think at this point, if it's a hedging their bets and trying to think of where they'll end up better over the next 5 years, they may opt to go variable. But we'll see. The other thing there's some talk about is that they're considering being able to like refinance or re-amortize your mortgage without having to requalify.
Yeah, I saw that.
So essentially what that means is, you've got your 25 or 30-year AM, whatever it is. They're talking about giving you the option to, and say you're
10 years in.
Yeah, say you're 3 years into it even, right?
Sure.
Now they'll let you re-amortize, which will actually bring down your payments, right? Because you'll be stretching them out for another 30 years. Without having to actually requalify for that mortgage, because obviously you would have to go out and get the new rate, and there are going to be people who will not be able to qualify for the mortgage that they have on their home. We've talked about that a little bit, and that's where
Tons,
people
like,
end up, in trouble on their house and having either pay in or sell the property.
I'd say most almost.
This would allow them to effectively stretch out the mortgage automatically without having to requalify, which again, sounds like the bank doing you a favor, but it is effectively saying, let's kick this down the road. Let's make sure you don't get any equity in this
Do you think
property.
next year will be so bad that they're going to put in 50-year AMs? So right now, again, just to go over what Chandler just said, so when you get a mortgage, everyone knows you can get around 25 to 30 years as an amortization, so they stretch everything over that, and then you basically pick your rate for the next 1 to 5 years, commercially up to 10, I think. Now, to lower that payment, it used to be like 15, then it went to 25, then it went to 30.
There was time for 40 years there.
And there was a time for 40
40
years.
years, zero down. Let's go. How did we create this problem?
then-
I have no idea.
And then Europe has like 50. I think some parts even have like 99-year like mortgages and stuff like that. Like I think in Asian countries, I'm not 100% sure. I'm probably going to take some heat on that one, but I think it might bring us 50 or more AMs. I've been hearing some rumblings. A couple guys in the bank I was talking to, they think they might stretch AMs.
I think they'll stretch AMs, but 50 years certainly sounds a lot.
That's the next step. Where do they go from? You think 40? I guess it might go to 40. In my head, it's like 25, 30. I don't even think about 40. I think it's 50 is like the next. I think you can get commercial mortgages like do 50 already.
Skip a few 99, 50-year AM.
They'll have to do 50s for developers too. That's the other thing. Like,
oh, totally. Some
if
of
you're
that
cap rating at 4% or 3.5%, and you're paying a 7% rate, like it doesn't take much math to figure out that you're negative by a lot every month.
Yeah, we've talked about a lot of the challenges that are going to be coming up to new development, and this is why housing starts are just grinding to a halt, and that's going to be problematic. I'm going to jump to something else you talked about, which is believing that migration is going to be curbed, but I'm going to throw some stuff at you here.
Okay.
Canadian population growth in Q3 was the fastest since 1957. In fact, we grew by almost 300,000 people, and considering we got a population of about 40 million, you know, that is
almost 1%. That's insane.
It's close to 1%. And international migration was just under 95% of that migration.
Okay, hold the phone here. So in Q3, we got 300,000 people?
Yes.
So in one quarter, almost 1 in 100 people are new to this country. So if you go to like a concert hall with like 1,000 people, there's going to be 10 people in there that were not even in this country like 6 months ago.
Correct.
That's insane. Like, I don't know if anyone's thinking about that. That is like insanity, and also kind of why we're probably facing some of these inflationary things that are taking place on both the housing side and everything we consume.
Well, again, that's you implying that it's demand-based inflation. I think it's a supply-based inflation. But
either I mean, if you curb demand and you have no supply, it still goes to zero. Like it's
it's inflation either way. So this is why. You know, there's the question out now, like, all right, well, how far can the housing market fall? And I do think it has these naturally built-in bottoms, and I do think we did a major correction, a major come down, and now what I'm seeing out there, and I say this anecdotally at least for this point, but I think you can see a leveling off here. It's now a drip, right?
Mm-hmm.
It was a one-time correction, and now it's a drip, like marginal decreases. Like there was a time where literally the home down the street sold for $600. Now this home is selling for $525,000, right? Like that happened. I don't want to say overnight, but pretty damn close. And now I see it's like, all right, well, that one's $525. The next one might be $515. The next one might be $510. You know, and we're kind of settling off there. And for a couple reasons. One of them is really interesting. I want to get your take on it. The supply, we've harped on this, is way down. Like the sellers just are not selling their home. They're just not. And that's why you're still seeing in major markets, like our market, still 30 to 35% of homes are selling over ask every single week because inventory is so low, and that is helping to protect the pricing. But I want to get it.
I'm losing confidence. Confidence is being lost at a rapid pace over here, almost as fast as the housing market's going down. But no, in all seriousness, so I think, like you said, so right off the hop, there was like this 10% cut on a lot of properties that were kind of overpriced to begin with. Those are the ones that got beat up the most. They weren't great properties, but they were selling like mad because the market was nuts. Then now, like you said, it's more leveled out, and I feel like I look around, I'm like, oh, like now, like you said, they come on, they sell, they get 2 or 3 offers. There's still that kind of pent up demand. I think the original fall wasn't really justified by anything other than sentiment of like people being scared. Like they're seeing all these reels of Chandler talking about the rates going to hell and like stuff like that going on. And now I think we're kind of leveling out because rates are still not that bad. We've talked about it. People can go out and get in 4.5% to 5.5% money, which really a few years ago was pretty normal. And so that's not out of this world for a couple to be able to go out and buy a home that's still in the $500,000-$600,000 range. So here we don't feel it as much. And I do agree that there's a supply issue, but I'm also starting to see a lot more price reductions take place. I'm starting to see withdrawn listings. I'm starting to see houses be
totally. That is
a
normal market.
Being relisted for less than they just paid a year ago. I'm seeing like I'll come across those every day now when I browse through, and I think we have not felt the pain. Like I think the pain is to come. Where like
I'm feeling pain.
I was. That's because you're hungover. No, that's you're on day 3 of your hangover. But I was in the bank, and literally the 2 people in front of me were asking for mortgage deferrals. Like it was awkward because when you're at the teller and like I can hear them and they're talking about asking for mortgage deferral, and I'm like,
it's like, so you realize we don't do that at the teller?
Yeah, we don't do this at the teller, but I can hear it. And I'm like, This is crazy. And I
Yeah.
think
Yeah.
I think we're about to go through our Christmas season. The North American culture is to spend, and you feel very bad if you don't. And so everyone's going to feel basically the pressure to spend like they always do. They're already over leveraged. Values are way down. There's going to be a lot of people next year that get beat up. And I think where we're seeing core inflation has not dropped. They're going to keep increasing the rates pretty close to the pace that they have been. And so then anyone who's in the variable products, anyone who's out there now and has any sort of loan or debt, they're going to be in tough shape. And a lot of people went out there and spent a ton of money on cars and auxiliary properties, and like you go to sell secondary property markets are going to start falling off heavily, and so they're going to sell these, take losses there.
Man,
boats, cars, all this
counterpoint. It's still the third best market we've ever seen. You've got this recency bias, man. Like you're
But we're not there yet.
like, people are doing price reductions. Like, man, like this is still.
I'm saying it hasn't
best
happened yet.
market
Though.
ever.
I'm saying it hasn't happened yet. I'm saying like in the following year, I think it's actually going to happen because right now people aren't selling really because they have to. I think people are going to start selling because they actually have to here at some point.
So here's a couple things to your point.
And like you said, unemployment's going to come, and when unemployment comes.
Yeah, but so the interesting part about this is that sellers are buoying up the market by just refusing to sell, right? Which we kind of expected would happen. We
have a high
before.
population of people with no mortgage and low mortgages.
Yeah. There's also a high population of people that are saying, we're going to sell, but we're going to wait till this blows over, which means like they are going to sell. There could be an influx of a lot of homes hit the market in the spring, right? Like you said, like maybe these people are riding it out to see where the dust settles, and they could all come up on spring. The other thing is, ironically, you can look at that 14% since March, right? That we're down 14% since March.
Yeah.
We're still up from this time last year.
Yeah.
And in many markets, like we talked about how resilient Alberta's been, we've been very resilient here in Nova Scotia. Mm-hmm. Because the sellers are not selling their home and they are keeping prices high, it sort of is giving our boy Tiff permission to just continue turning the screws.
Is he our boy?
I hate that guy.
But yeah, he's increasing.
That's a cruel irony. It's like, all right, we're fighting for our lives here as like sellers and property owners, and he's like, you guys have more resilience than I thought.
This is it.
Jacking it some more.
That's what I mean. They have to get they have to get this to turn over, and so they're going to keep doing it until people cave in. The other thing that is similar to the sentiment, it's once people started seeing prices drop, like just like when people started seeing prices explode, everyone's like, man, I got to get 2-3 more properties. Like everyone was scooping properties up left, right, and center. The second people started seeing prices fall right off, they're like, oh shit, like I don't want to be in this. Like I'm going to try and get out. So there's a ton of people that own second property. What was the ratio of people owning second properties that they're going to start throwing this up, whether it's a rental or it's a cottage. They're going to be like, I don't want to hold on to a depreciating asset. Nobody wants a depreciating asset, right?
Yeah, we're going to have some stats next week on the drop off of Airbnbs. Like there's been like Airbnbs have declined in activity quite significantly. That's a sign of people not spending. Like you know, tourism is going to see the same sort of thing. And part of that's seasonal. Don't get me wrong. A lot of that is seasonal. But I think that's going to reveal some interesting things because that's people deciding not to spend a little bit of extra money in their local economy most often.
The last thing I want to mention, I already said it once, but Christmas season's on top of, like you're saying, everyone's holding on to their properties, which is kind of making it more tough. And Tiff's like, I'll just keep dialing this up to see what your tolerance is. Going into Christmas, the extra spending will not be helping inflation numbers, right? So like it's like a setup. I don't want to say we're doomed to fail, but I really do think there's going to be a beat down here. And I think a lot of people, like, we can get through this. And if you're smart with your numbers and you watch your stuff, you can get through it. But there are people that are over leveraged that are going to get really beat up. And I think the toughest part is going to come when the unemployment comes, because it doesn't matter if you're like, I was perfectly leveraged, but then if you have no income, you're not perfectly leveraged.
I want to fire some Ontario stuff at you.
All right.
Okay. So we'll start with Toronto. Go Jays. You did it. In Toronto, downtown Toronto, still 39% of property selling over asking. The city of Toronto, 33% are still selling over asking. In the 905 areas, 26% still selling over asking. Having said that, Toronto for September, once again, for I think like the 7th month in a row, hit a 20-year low in inventory. It dropped just from August to September. The number of deal volumes dropped by 10% just in 1 month. Sales down 10%. From last year, from September of last year, sales are down 44%.
That's insane.
So sales are down 44%, but they're still showing some price resilience in a lot of the micro markets. Interestingly, condos are up. and then low-rise, single-family townhouse stuff is down, but condos are up because people are effectively being pushed to more affordable living, and condos offer that. So that's an interesting take on what's going on in Toronto.
Let me just comment on that really
yeah,
quick.
jump in on it.
So, to what you just said, immigration, 300,000 people in Q3. Probably 70% of those ended up in Toronto. So that in itself is why you're seeing these over ask and this massive demand. But again, if they curb immigration, this game is going to get beat up. Just that simple.
So I'm glad you mentioned that, because, and I'm going to read something here because it's just a lot of stuff at once here, and I don't want to miss stuff. People are actually leaving Ontario a bit more than you might expect. It tends to be people's first destination when they're coming from another country, and then they spread out.
Yep.
So listen to this. In 2021 alone, nearly 108,000 Ontarios left.
Ontarians.
Ontarians? What did I say? Ontarios?
You said Ontarios. Cheerios.
Like Cheerios. Over 100,000 Ontarians left the province, and that continued in the second quarter of this year, when an additional 49,000 left Ontario to go to other provinces, which again, it's their highest interprovincial migration since 1971. About a quarter moved to Alberta, and another quarter moved to the Maritimes. So we are actually getting here in the Maritime provinces, and most of those people, if they're moving to the Maritimes, where are they moving?
Halifax.
Yeah.
But so they got 200,000 and 49,000 left. So they had 150,000 net positive.
I'm just saying it's very interesting to see how many of those are coming here.
There is the largest migration out of there, but we're also having the largest immigration to our country of all time. So it's like there's still net positiving a ton of people. Like it is insanity in those places.
Yeah,
we're feeling it here, and we're having a
we're getting a
net
rush.
positive, but
yeah,
I'm not to hate on the Maritimes in any shape or form, but I do have some concern that all these people that moved during COVID, we talked about when it first took place. I don't think we're not going to have 100% retention of these people. Like, we're going to have 50% retention. Honestly, if that, I think there's a mixture of reasons too. There's lifestyle. Like, if you're coming out of Ontario or any other big city and you're moving to the Maritimes in any of these cities, it is a dramatic change in lifestyle that you may have not been prepared for. Your job may be
pros and cons with that.
Your job for two things might be well, it's not COVID anymore, get back in the office, or we're doing downsizes and we're doing cuts. If you don't work in the office, you're getting cut. We don't just have all these people all over the place. The other thing is, again, prices start going down and they see more stability in a bigger market, they're going to move back to that. So there's a lot of different things that I'm we might not retain. The other one I was going to mention, and I'm seeing this, is they can't even get a house or a rental. I had someone message. We had someone message us. This is kind of crazy, but we had a message come in for one of our units the other day, and he said, "Hey, I moved here from Quebec 3 months ago, and my family and I have been at a campsite for 3 months."
Do you know what they're telling international students at Dell right now?
Do you think he's going to stay in Halifax?
If they don't have an apartment?
What,
tell them to go home.
Tents? Oh, go home.
They're telling them to go home.
This is what I mean. So they're and then you're going to curb the immigrant
Yeah, so just to finish the point, though, in the second quarter, both Nova Scotia and New Brunswick saw their greatest net gains from interprovincial migration since 1971. So as there's some downward pressure on the real estate market here in Nova Scotia and in New Brunswick, we just took in more people from the rest of the country in the last half century.
Which is, all of these things are amazing, but they don't stimulate the Canadian, basically, industries enough to meet the demand that they created by bringing all these people in to try and fight the issue of the amount of money that they just dispersed into our economy.
Yeah, and it's all these contraction, in theory, some of these people will alleviate some pressure on the labor market, but they will then put some pressure onto the housing market. So it's a lot of different forces. If you
I don't know what the thought process is when you're okay, we're going to bring in record numbers of people.
Tax dollars.
I understand, but if you don't do any of the stuff with like business incentives to get all the businesses going to service all of these people and to supply all the things that these people need, what are they thinking? Before they're okay, we want to add 10 million people by 2050. In advance, they should be okay, we need 10 million homes or apartments or whatever, and we need to start those now.
Yeah, but you can't start them now because you can't finance them. And this is the cruel double-edged sword that we're dealing with right now, which is why I agree with you.
Create incentives?
If they're doing all these things
and businesses,
with relaxing the stress test on residential, maybe allowing some longer amortizations on renewals, I think they're going to have to do something for new construction. They really are. I'm going to end us with this up note, I don't even know what to make of this, but it made me
Made you happy?
laugh when I saw this. So there was a recent report by the National Research Group in the States that found consumers will cut spending on food, but not on Netflix. Roughly 2/3 of consumers said they will have to decrease their spending due to inflation. However, only about a quarter plan to cancel subscriptions such as Netflix.
This is that's the best article. Yeah, how much did Netflix pay that who did the work? Who did the research?
The National Research Group.
Yeah, you trace back the money that funded the national. Like, oh, we got a grant this year for $6 million or $60 million from Netflix.
But you can take that a couple ways. One, you can take it that our priorities are hella messed up, or two, that entertainment matters because we're going to have some mental health challenges as we struggle through this. And man, sometimes just chilling out and watching a bunch of Netflix is good for mental health, even though that's
if you're really hungry because you didn't buy food, if you just put on a really good Netflix show, you'll forget that you're hungry.
Oh, speaking of which, the Buyer's Home on Stranger Things. You watch Stranger Things?
No.
All right. Well, Buyer's she had the lights up. That house is actually listed for sale for $300,000. I think it's in Georgia. But
that's not
anyway,
bad.
Yeah. So we're going to transition now into a really cool conversation about private money.
This is my boy
with Ryan MacNeil. This is Neal's legit boy.
The guy that I was talking about when I say I can shoot him a text and they wire me money. This is the guy. If you do call him, I'm going to charge him 10%.
Yeah. Call us. We'll refer you.
But no, anyways, it's a really good conversation. So we're going to switch studios and dive into it.
Yeah. All right. So, yeah, we got a guest here today. Super excited about it because so many people reach out and ask us about this idea of private money or alternative lending. And apparently they're all too cheap to check out the Patreon. Haha, just kidding. But there is great stuff on our Patreon where we talk about seller financing, private money, all these sort of things. But we wanted to break it down here with an episode for everyone. So, Neal, you want to introduce our guest here?
Yeah. So for once, we actually brought in my boy. We always call everyone my boy, but this is actually my boy. It's Ryan MacNeil from Graysbrook Capital. Yeah. Say hello, Ryan.
Hey, guys.
And
glad to be here.
Yeah, he has done, every time I've alluded to private financing, 99% of it has been through Ryan. He's been the guy that I text when I'm in a tight bind, and he's looked over all my numbers, and he's gotten me out of different
Neal sends
deals.
Ryan these texts at 1 a.m. You up? Winky face? Winky face $sign?
Yeah, exactly.
He's my boy after all.
So. Today we're going to go over basically all the questions you guys would be interested in hearing, cost breakdowns, what it looks like for them to loan for you guys, things they don't want to see, and then also some of Ryan's opinions on stuff that Tiff has said. Tiff Macklem, he came and presented here in Halifax, and where we see rates going, potentially where we see the market going with foreclosures and all of that. So, let's hop right into it and maybe do an intro here for yourself, Ryan.
For sure. Awesome. Well, first off, thanks for having me, guys. Really appreciate it. You guys do awesome work on this podcast, and
thank you.
Great to be a guest. As Neal mentioned, name is Ryan MacNeil. I'm the Director of Alternative Lending for Graysbrook Capital. Been doing it for about 5.5 years. Business has grown substantially in the last couple of years. It's been 5.5 years, but it's felt like a lot longer the way the real estate market's been the last couple of years. So I feel like I've had a career and a half of experience in that time. Just a little bit about me. I in a past life similar to Neal was an engineer. He's got the ring showing right there.
Giving those things
I don't
away.
wear mine anymore. That lasted about 8 months for me, so I quickly realized it wasn't.
Neal will be buried with his.
Yeah, absolutely, absolutely, very proud. I don't blame him.
Yeah.
It kind of led me to my passion, which was business. I ended up going back to business school, did a couple co-op terms, did the Bay Street thing for a little bit, and realized I didn't want to be part of the Bay Street fashion show, nor working 120 hours a week. That led me to the consumer goods industry, where I got to work with a couple Fortune 500 companies. Got my training in sales, key accounts, working in business analytics, and that really laid the foundation for me for my career. So despite the fact that the first time I learned about a mortgage was when I bought my house 5 years ago and started selling mortgages the next day, I felt I had kind of the foundation there with my analytical and sales skills to kind of build a network and, meet many broker and realtor partners around Atlantic, and led me to where I am today.
That's actually quite an impressive background. I knew about the engineering. I didn't know about all the other stuff. So that's, and like you said, it leads into you being the perfect person to fit this role, I think, honestly.
Thanks.
So you've had a crazy couple of years. Did you enjoy the last couple of years, though?
Definitely enjoyed it. Maybe less so in this unpredictable market we're in right now, but certainly enjoyable. It's been very It's gone very well for our business, let's say. There's been a heavy need, and I know we were talking about it before we started recording here, that there's been a much heavier need for private financing for a multitude of reasons, which I'm sure we'll get into. But it's been very good and a lot of learning for sure.
So who is Graysbrook though? Because people may not be familiar with you or have heard you by name, but don't really know maybe your connection to credit union, for example. Yep. So what is Graysbrook?
Absolutely. So in the simplest terms, Graysbrook is an equity lender. So that's what we're looking for at the end of the day. We're an equity lender. We focus on short-term deals, typically 6 to 12 months, sometimes a little bit longer, sometimes by our choice, sometimes not by our choice.
Neal's the lifetime.
You saw how he looked at me when he said that.
Neal's the lifetime commitment package.
He's paid his bills. It's all good.
Yeah.
So really at the end of the day, we focus on equity and exit strategy. Those are the keys with Graysbrook. We do a multitude of different deals that we'll get into, but just a bit of the background on Graysbrook. So Graysbrook was originally a family business. So my dad and my uncle actually founded this business in 2006.
Oh man, I did not know that.
Yeah, so that's how I actually got into the business. So,
No way.
Because it's very difficult with the disparities in incomes in Ontario. I should have mentioned as well, I was in Ontario for my business career initially. Moved out east when I had this opportunity with Graysbrook, but so I was very fortunate to come back into a family business. Like Chandler alluded to, our business was sold to CUA in 2019. So CUA is basically our parent company, our sole investor. We still operate completely independently and make our decisions independently of CUA. But that's when kind of my father and uncle moved away from the business into retirement, and I was able to kind of take a leadership role within the business at that point.
So are you from Halifax?
I was born in Halifax, grew up in Moncton, and went to school in Fredericton, and then moved to Ontario after that for about 10 years.
Gotcha. I know that's interesting history, because I didn't know that in advance of this. But I was always felt that alternative lending, private lending was like the big bad boogeyman. And oh my gosh, you're dancing with the devil if you go down that road. And this is a digression from what was on here, but that was kind of my naivete early on. And it's not to say it's without risk. It does have risk. But it's interesting. It actually kind of gave me a sense of comfort to know that you were affiliated with CUA. And it's like, okay, this isn't just some guy, right? Yep. Even though, and it's also kind of endearing to know that it started from a family business. So.
It's a financial tool. Like it's something to utilize along your growth and to get up. Like I said, I use it to get started, and a lot of times you have to when you're getting started because most banks will laugh you out the door.
Yeah,
right.
That's it, Neal. It's intended to get our clients from point A to point B, right? Yeah. We don't want people staying with us long term or too long of a term because that's when issues start to happen, and we want people to be successful.
So who is your target?
So target clients. And I'm glad you mentioned that as well, Chandler, being the big boogeyman, because that often is the myth that comes along with private lending and with Graysbrook Capital in general. Some people have the stigma associated with it that it's people with damaged credit or have been through multiple bankruptcies. Yeah. But we actually have a very strong credit profile for most of our clients, and they tend to be high net worth. So I'd say the ideal client profile we see is someone who is equity rich and maybe needs cash flow for a variety of different reasons. Often we see business for self clients who don't claim their full income, but they do make a ton of income that just happens to stay in their business. Yep. And I'll get into, construction and renovation loans a bit more as well, but that is another one of our key kind of clientele is people who have some experience in that field, whether it's construction trades, home renovations, home flips, because we love those types of deals. And that's where we tend to have strong client profiles as well.
And so as that client, are you looking for people that are building homes? Are you more interested in renovating properties? Is it like, what is kind of the ideal, asset that goes along with that person? What type of people do you go after? Yeah,
so both. Typically the equity in a scenario like that, if we're talking construction, is in the land. So we like to see the clients either own their land or put, maybe 50% towards the land purchase price. Yeah. So they've got kind of skin in the game that way. Renovation loans will do as well. It's always case by case. We prefer, stronger locations, of course, as well. Although we have done some in rural areas as well. So it just really depends on loan to values and, a multitude of factors. But, we fund renovations. We base our decisions as well off of the as complete appraisal. So it's not necessarily just what your cost is going to be for the renovation or construction. It's really what it's going to appraise out at the end of the day that we're basing our loan to value on.
Yeah, we talk a lot about that as well in the Patreon episode. But so I think you've unpacked a lot of it there, but what are the benefits kind of working with you guys? There's the speed, obviously, and Neal touched on the fact that, someone starting off, AA lending just may not be an option for you.
Yeah, I'll say one minute before you answer, but like I said, I mentioned there was speed. We were talking about this before we came on the mic, but I was able to text Ryan and within probably 48 hours have cash in my accounts. That one was so, and what's funny is I started in this private world working with Ryan, and so then I moved over to the banks after, and I did not realize how slow a draw can be. By the time you got an appraiser in, got the percentage complete, sent it to the bank, it went through the 13 levels that they need to get it approved, then they come back with 10 questions, and it goes back through those 13 levels again, and then the funds get sent to a lawyer, and then the lawyer lets go of it once they're ready to go. It's like 3, 4, 5 weeks, if not longer sometimes. So I didn't realize how lucky I was.
And you touched on the difference is you still need appraisals, and appraisals have to happen, and they take some time. An individual still has to have things like, NOA or something equivalent. You might need rent rolls, all that sort of stuff. Yeah. But it's after you've dressed this perfect package and you send it to an A lender, they're like, we're going to look at it for 5 to 6 weeks, and then we're going to fund whenever the heck we feel like after that, as far as I can tell. And the difference,
speaking from a spot right now.
Well, the difference is you guys have a bit more autonomy and less rungs to go through, where it's all right, here's a complete package, we can take a look at it and make a decision.
Absolutely. So we're making all the decisions in-house and we make them quickly. So that's the key thing at the end of the day is speed, like you guys both alluded to, right? So we're turning things around. We've done some deals as fast as 24-hour turnaround times, and that's from approval to funding. Typically it's 48 hours, and we almost guarantee everything is done within 7 days. So it's very quick, and that really what.
But that's from the time of having the appraisal, having the full application.
Absolutely.
Yeah.
So you need to have the appraisal in, and that includes legal and getting the funds out the door, right? So things have to kind of fall into place for that. But you mentioned appraisals as well. So yes, we do need to have an appraisal done, but in your situation, Neal, as well. I'll even go to site sometimes and do inspections rather than having an appraiser, waiting for that appraiser to go and schedule it in 2 weeks from now, send a report. I can usually go there and determine whether the windows are in or whether a home is weather tight or not. It's not that difficult.
Yeah.
So, that's one benefit.
That's where
we
the
have
engineering
as well.
degree comes in.
Absolutely.
Just knowing if the windows are in.
It took 5 years to find out about how that works, but
the other key thing I wanted to mention as well, and this is one we really pitch, is that our mortgages are fully open as well. So yes, our rates are going to be higher than you're finding at the bank because you get the advantage of speed and other factors and flexibility, which are big things for us. But the open mortgage aspect is key because if you're with us, and you get your project done in 6 months, 8 months, 12 months, whatever it might be, you don't have to pay those penalties on the back end to break the mortgage. You pay us out, it's clean, is what it is. You refinance your property, and Bob's your uncle.
To that note about flexibility and stuff, what are some unique situations that you guys have come across that you've dealt with, maybe regarding environmentals, burnt down buildings?
What are you alluding to?
And just other weird scenarios like that. What have you guys looked at that I think most banks wouldn't have the risk appetite to take on, but you guys have gotten into?
Yeah. So I can chat on a couple examples there, and if you don't mind, Neal, we'll chat on your property that is quite a unique one as well. But so Neal had this property that he brought to us. I guess it was 3 or 4 years ago now that had burnt down. It was in a decent area of Halifax, I guess. Up and coming, we'll say, but it's one of those ones where there's different factors, but we were still able to be in first position. I think there was a vendor take back associated with it to kind of help offset your down payment. But for us, we're still secured in the fact that we're in first position. We were about 65% LTV. I think there might have been another asset that we leveraged, maybe a personal property or another property you have, just to kind of as a sign of good faith for our first deal together. And that's one there where we based it off the as complete value again, right? So you were putting in the renovations to get this place up to spec, and build it up and increase the rents, and all went smoothly. We took a bit of a gamble on you, but seems to have worked out pretty well so far.
You also had the advantage of you had a contracting company right through your restoration company, right? That helped the application as well.
Yeah, we talked about that a bit too, and I think we put it. I remember sending in a resume, I think, to you guys as well as a background that I had the contracting company, I had the engineering degree, and then we put up. I had a duplex that I was living in.
Oh,
and we
I
put
would
that
love
as a secondary
to see. Can we get a copy of that resume? I would love to see
I
that.
was really
dated.
good at Nintendo
1 year dish
64.
pit at Moxie's.
Yeah. Worked with a dishwasher.
No, but that's interesting. But even that, just like the subjectiveness, the freedom to be like, all right, well, what's the total picture here? Because other lenders, if you don't fit in that box, it's like, well, you don't fit in the box, right? Where you've got the discretion to say, okay, what's this person's credentials? One, he's a licensed real estate person, so he should kind of know a little bit about what he's doing. He does have access to tradespeople and an understanding of pricing. All those things can kind of roll into it. Like, what for you would make a deal killer versus a slam dunk? Like, what's if someone says, I've got this situation, here's my equity position, like what you're like, okay, that
what
right
kills
there.
a deal for you guys?
Yeah, so deal killer. I'll focus on that one first. I'm glad you guys brought this one up. I got a good story for this one. So, this is one here. So if you got like a super rural property and it's super high LTV, chances are that's not getting through. But this is a funny one, and we've seen this example come through a couple times. And there's one in particular that I remember from a broker partner we had, and it came in and. The deal, I think, was in Spring Hill, Nova Scotia. And no offense to the good people of Spring Hill, Nova Scotia, just not one of our
Was it an old decommissioned mine?
It was about $100,000 property, 80% LTV, and we're typically in that location maybe 50, 60%.
Right. That's loan to value for people who are kind of
loan
like,
to
okay,
value,
that
correct,
means the person wanted to borrow 80% on the value of the property, 100,000, and you guys would be more comfortable in a location like that, at like 50% of the value.
Exactly. Just a risk mitigation tool, right? So this particular client had either one or two bankruptcies in the past and was currently in consumer proposal. He'd borrowed his down payment from his sister and his cousin or something like that. But the broker, and he pulls in, we're all sales guys here, and the broker pulls out the sales tactic. He says, but he's a really good dude. And I looked at my underwriter and I said, well, you should have told us that first. He's approved, right? So, but I thought that was a funny one, and we get that all the time. I know this guy really well. He's a really good guy,
Cool.
right?
So you want to spot him 100,000?
Yeah. We're going to lose 30 grand on this deal, but at least he's a really good dude. So no big deal. So I'd say that's kind of the biggest deal killer is something that's high LTV, rural locations, past credit issues where it's more likely that they're going to default, because we don't want it. There's also that stigma out there that private lenders are in there to go get properties. That's the furthest thing from the truth. We have zero interest in the time that goes into having to chase money and sell off a property and the legal process associated with that. So really no interest in that. And in fact, that leads us to sometimes being more flexible to make sure that client does get out and does successfully, whether that means selling their property, refinancing, or whatever else to get out of the loan.
Yeah. I mean, there's some people who I think believe that private money could be a catch-all for anything. And I know I sometimes feel like a buzz killer. People are like, well, listen, I want to buy a 12-unit building. I have no money and I'm not gainfully employed, but I'm a hustler. And I'm going to find a seller who's going to do, a 15% vendor take back, and then I'll just do private money for the 10%, and then I'll just get a loan. It's like, man, it's not quite that simple. You still have to have skin in the game. You still have to have a solid overall portfolio. You still need to have some cash. There's this misconception that you can just run around with 0% deals all over town, but like you need some cash.
And that's exactly it, Chandler. I think, skin in the game is key for us. So yes, there is certain scenarios where we will, accept a vendor take back, but if the client's only putting 5% down or trying to do 0% down, we're not interested in that. It's too easy for them to walk away from the deal if something goes sideways. And then we're, kind of stuck with that asset.
Now you're a proud owner in Spring Hill, Nova Scotia.
To your point, I mean, I know some deals you guys have worked on that you guys will work with your client to help them get through their exit strategy, because again, you guys are not interested in reassuming the property, especially in today's that last couple of years. People believe that because I think if they get the property, they can throw it on market and get 10x their investment.
Sure.
But in a normal market, there's a lot of times that if you take a half renovated property that you've now
the next person can't finance it.
Budget,
the person buying it can't finance it. Right?
Person buying can't finance it. It's not fully done. You know what I mean? So you run a huge risk in assuming that property. So we've talked about some of the deal killers. What's something outside of maybe credit score and income that would be a great way to get approved? Obviously, is it just really appraisals your number one big thing, making sure that there's equity in that, or is there another thing that you see it comes across it's a nice bonus to have?
I think experience, Neal, like you said, when you submit that actually does hold weight for us. So, when you talk about the experience you've had, whether it's, renovating in the past, or you work with contractors, or you've done it before, you've built 10 other homes, that holds a lot of weight for us.
What if he's a dick?
Well, you got to be a really good dude. I already touched on
Well,
this. Right?
that's the thing, man. That's a yes or no. Good dude. Yes, no. Dick, no.
But yeah, that's kind of the key thing for us, and I'd say that's even more important than credit profile. And I feel like I've mentioned credit profile a bunch of times now. That is lower on the priority for us than the equity or the experience for the client.
Yeah, no,
And you can actually see them through, and you can understand sometimes credit profiles get beat up, hence why they're
Exactly.
working.
And often people we deal with too have, high utilization because they have 5, 10, 15 properties, right?
Yep.
So the credit score might
Line of
show
credits.
lower, but
Yeah.
we look at that and we take that into consideration, and that, is still just as good as someone with an 800 credit score if that's the reason.
I gotta say this because this is a personal situation I'm facing right now, but like I have a decent credit score, but I pay all of my bills on time. I have nothing that's behind right now. Yet it still went down. It only went down by like 2 points. But I just started monitoring it, and now it goes down like 1-2 points every time the statement comes out, and it's literally just
Well, it's probably
because I
you
have
keep
so many
checking
different
your
things.
credit.
Well, those apps don't do that.
Yeah.
Do they?
Yeah,
Those
teasing,
apps don't do that. But
No,
like,
that's also a bit
That's
of
what
a,
they say.
a lifestyle. But a lot of it is, you may pay your credit card off religiously every month, but if it has a $5,000 limit and you're at 4,800, like that's going to ding your credit regardless. I know it's kind of
it's kind of wonky. Like that's what I'm getting dinged on is that I have a high amount of money on my card, but none of it is carryover from the previous month.
yeah. Also, like you can get real savvy and figure out what day they do that measure and just like put it down to zero on like
what
the
I'm doing.
13th of the month and then take all the money back out on the 14th. But they don't like that and they charge you more interest on advance. Anyway,
Speaking of interest,
well, yeah, no, before we get into that for a second. So you guys do everything from someone wanting to finance a small home purchase or flip or something like that up until what? Like what's your upper threshold limit?
Upper threshold limit is typically about $3 million in most scenarios. So
Of lent money?
lend money.
okay.
So, in terms of units, that typically equates to somewhere between 12 to 24 units, I guess, would be kind of the max that we're looking at. So our sweet spot would be somewhere between like 4 units to 24 units, I'd say, for the
Gotcha.
most part.
Yeah.
And I know you mentioned on a past podcast as well that, some of the big opportunities are going to be in these smaller scale construction of your, 2 to 6 units.
Yeah.
That's been our bread and butter for years, is doing those types of deals where, it might be like 4 townhomes built on slab, targeting a senior demographic or something like that in a Truro or Elmsdale or something like that. We've had a ton of success with that, and the borrower tends to do quite well on that and get the lift they're looking for.
Yeah, so in our last episode, we talked a little bit about new construction, but that'd be an instance like, say someone could get, a really smoking deal on a piece of land and maybe they're able to buy it cash. Say they can come up with the cash to buy a piece of land for $100,000, and then through a development agreement or subdivision, they're now able to knock off 4 units on that lot. Well, now that property goes from $100,000 to potentially worth, $300,000, and then now you have $300,000 worth of equity, and you would come to Ryan and say, okay, here's the cost it's going to take me to complete this project, but I already have $300,000 worth of equity on it. This is the end complete once we've got these 4 units built, and if those numbers jive between your $300,000 of equity in the property and your kind of gap between your as complete and what it costs you to build those structures, now they can lend on it. So that's the sort of thing that we're talking about and that Ryan would kind of have interest in. Is that more or less right?
Exactly right. And typically in that scenario, on that as complete value, we're doing about 65 to 70% of that as complete in terms of your construction budget, right? Or our total loan size.
So like hypothetically, like say you'd be all in on the project for, 4 units, say you could build them really cheap for $800,000. So your all in would be like 1.1 million, but you've got 300,000 in equity. You would loan on the as complete, or
we loan on the as complete. Exactly. So if that comes back and it's, we're funding 700,000 of that, then you've got pretty much your costs covered from the loan.
Because maybe those appraise out at the end at 350 a pop, so they're actually worth whatever that is, 1.4. I mean, you guys got the rings, whatever that math works out to. I think it's 1.4 million, right? So anyway, people can mess around with the calculator and figure that out, but that's a great little hypothetical example there.
yeah, totally. And so now someone's gone through the whole process, they've gotten approved. What is somebody looking at for expenses on money like that? Like I said,
The rates, yeah.
we want to know rates, and then there's also
And
deal
fees.
fees associated with
Yep.
it. And then I know we'll say like, is there any monitoring expectations? You said you'll come out to site yourself. I don't know if you want to just break down kind of what you see as the whole package.
Yep.
What somebody would face.
Yeah, absolutely. So, we're very transparent with our rates and fees with our clients. So, your biggest consideration is going to be your interest cost, which is going to dictate your monthly payments.
Yep.
There is lender fees associated with it. Typically ranges from 2 to 5%, depending on the situation.
Okay.
And that's basically cost of doing business for private money.
Yep.
But one thing I will mention on our rates as well, in a construction project, which we do a lot of, a renovation loan being the same thing, we only charge interest on the amount that's drawn. So there is some private lenders out there that will say, this is your $400,000 construction loan that we're only advancing $100K on right now,
We're charging on
but we're
400.
charging you on the 400. We won't do that. We'll only charge you on what's drawn. And some people don't even end up needing that 400,000. They might only need 250 or 300, right? And they've been able to scrounge up their own cash or whatever else, or make some savings to put towards it, right? So that's been the key thing.
That's super nice. I can say I remember I dealt with a different bank and I had a full construction loan approved, and then I ended up paying interest on all of it. And I was always nervous, but with you guys, I'm like, I'll get the max approved and ready to go, because realistically, I'm not going to pay on it until I draw on the actual amount, and then I pay on specifically that amount on a monthly basis.
So say someone's borrowing $200,000 up front, there's kind of a 2% to 5% fee. So that's $4,000 to $10,000 just for borrowing the funds.
And that's usually withdrawn from the funds that are being
That's,
advanced.
that's
so
right. So we'd
get-
advance 190 instead of 200 in that scenario, right?
Exactly.
Yeah.
And then the carrying interest is what, typically?
So it's typically around 1% a month. So it depends. It ranges from 10 to 12% annually. But again, I know that sounds high versus what the banks are at, although it's converging at this point.
I just signed a grade A mortgage at 7%.
Yeah.
At like 65 loan to value. And I'm like, God damn.
Yeah. But one thing I always remind, our clients and brokers as well, is that it's not apples to apples comparison, right? You're comparing a fully open loan to, a closed loan that's a 5-year term when you're looking at that 3-4-5% interest rate.
I think also it's like you're comparing money that you actually get versus money you don't get.
Exactly.
So it's a non-comparison in a lot of respects.
Absolutely. So you get the flexibility. And the other things I'll mention in terms of fees as well, where, there's legal fees associated, which typically are around $1,000.
Yeah.
And the appraisal fees as well, which is, in the range of $400 or $500. You guys might know better than I on that.
Yeah. So realistically, to borrow $200,000 for 6 months would be worst case $10,000 plus
12 grand.
Call it 12 grand.
Yeah. 12 grand.
25K.
Yeah. So if you're looking at the opportunity to do a project or not do a project over the next 6 months, and you're building out if you're borrowing that amount of money, you're likely involved in a project that's worth hundreds of thousands of dollars. And so your cost exposure might be $24,000, $25,000 over the scope of the 6-month project to borrow, which again, you're comparing against maybe
Not
getting it at all. But even if you did get it, it would be 60% of that. So really the net swing is maybe $12,000 to do the project or not do the project. And this is why people use it. And this is where my stubbornness opposed to it in hindsight was a mistake. But I was genuinely scared of it.
And totally, and I think you're right to do so, because there is, like, if you're not smart with it, you can put yourself in a rut. But this was one of the big things for me, is when you look at a lot of other loans, like by the time they still have lawyers. The other thing that's really nice is, I don't know, I forget who you guys use, but it's much cheaper than a lot of other banks. Like when I fund a loan with another bank, I find I'm paying like $4,000 in legal fees to fund a mortgage, and I'm like, why? And so there's that aspect that I find you guys have been cheaper on. Appraisals and cost monitoring. Like, again, you guys are willing to work with almost all appraisers. You guys are willing to come out to site sometimes to help us save money or get things done faster. Cost monitoring and appraisals for other banks can cost thousands of dollars and take tons and tons of time. So there's that aspect. And then, again, the funding timeline, which we'll touch on here in a second. So, and you're still going to pay a deal fee on money that you borrow from a regular bank.
Yep.
And then additionally, where everything's open, when you go to pay out another bank, even on their open products, you might be paying 3 months interest. Once you boil it all out, if you have a project that you're doing in like 6 to 9 months, honestly, there is like that $25,000, you're probably spending 20 with a regular bank, but you have a ton of headache, and trying to get that money is a pain in the butt.
Yeah, absolutely. So a couple points I'll make there. Like Chandler mentioned, what's the cost of not doing the loan? And one thing I recommend to brokers when they're positioning this to their clients, or when we're dealing directly with clients, is, calculate the total dollar cost, just like you mentioned, Neal, right?
Mm-hmm.
Rather than looking at that percent, the absolute percent, right? So actually calculate what this is going to cost you, and look at it as a line item in your budget. And if it makes sense in your budget, then it makes sense to do the deal.
100%.
Always budget. That's I 100% agree with that. Make sure you put it in your budget. That's a lot of people don't put their lending costs and legal fees and soft costs into their budgets on these smaller projects, and that can really chew up, especially if you have a tight margin. You're really relying on getting out 20 grand. Like you got to make sure you put them all in there. And if the numbers make sense, then there's no reason.
I mean, man, if I need to have 15 grand in there for the porta potty, like I will slide this line item in there as well.
Absolutely.
So-
That's actually maybe steep for the porta potty. Like, Jesus, what are they serving on site? What's the food cart menu like
Taco
there?
Bell.
So we know cost.
Yeah, we should dive into these questions on some personal thoughts about where you think interest rates are heading, because obviously you're hyper tapped into this.
Yeah, so we'll say, so we went to the BOC presentation that was here in Halifax. Tiff Macklem presented.
Yeah, which actually hosted by Credit Union Atlantic.
Yep,
I
It was
believe.
hosted by CUA.
And Remax. I think we had a
And
little-
Remax.
Yeah.
Tiff, if you guys don't know, he's governor of the Bank of Canada. He is quite heavily involved in a lot of the decisions that get made regarding interest rate hikes and what takes place with money being doled out.
He's the face of Canadian monetary policy for
He's
sure.
the face of Canadian monetary policy. Chandler had to withhold himself from getting up on stage and punching him in the face. But
nerdy little face.
the presentation wasn't bad overall. If anything, it gave me less confidence than ever. And we were talking about it before we came on, but a lot of his answers seemed to be fairly scripted, and it was very political. Like he
Oh
never
man, he's been
answered anything
regurgitating
direct.
that speech probably in every luncheon that
absolutely.
he's done.
His English to French I was impressed. I was like, damn, he just slips that up like no big deal. Like
Yeah.
he is ready for prime minister. But anyways, we have a couple things we want to get your opinion on because him and I blab about it all the time, and I think everyone's tired of hearing what we think.
Yeah, and you don't feel the pressure to expound. Just kind of what your guts, what your thoughts are on these.
We're holding you accountable to your answers.
Sounds good.
The first one is, do you expect rates to continue going up? But like by how much and for how long? Kind of. And again, not exact answers, but roughly overall, are you expecting things to kind of keep running off the charts?
Yeah, I honestly thought we were kind of at the end of it until listening to Tiff speak last week, and now it's clear that we are not at the end of it.
Yeah.
I think we're going to see at least one or two more going into
October
Q1.
27th is the next date, or the 28th.
Yeah, so I mean, I think we'll certainly see an increase there, whether it's a quarter point or half point. I have no idea.
Oh, it'll
but
be a half anyway.
Yeah, likely. But I mean, and I think that's likely going to continue until the back half of 2023, realistically.
Like you'll think they'll stay high that, or you think he'll keep
I think
bagging it up?
I think they'll stay high until that point, and then hopefully we'll see some easing at that point. But yeah, I mean it's going to create more unpredictability, I think, in the market where this is going. I don't.
Did you guys peg off the bank rates or 5-year?
We don't actually. So CUA would, our parent company, but it's a private lender. We don't. So we're not tied to the prime rate. So we actually haven't increased our rate. So like I mentioned before, it's kind of converging towards our rate.
Yeah.
And so that's likely going to create more opportunity for us. The challenge being on the back end for exit strategies, right?
You can only push so hard.
That's kind of was our final question. Maybe you can speak to it now. Like this is all about the exit strategy. Even you open talking about the exit strategy. It's something we hound on all the time, is like your exit strategy, getting out of these deals. Do you have concern about that moving forward?
Yeah, I do. That's probably my biggest concern going into next year. I think there's going to be, the inventory is still crunched right now, right? So there's still a need for our construction projects and for people to, renovate these multi-unit commercial buildings as well. But unfortunately on the back end, I think we are going to be more challenged with takeouts, or developers are going to be less likely to do it because they're not going to have that same spread when they refinance, and they're having to refinance at a 7 or 8% versus 3 or 4%, right? So I do think that'll be a challenge for us going forward into next year. I still think we will see a lot of opportunity, both with construction, commercial multi-unit loans, like I mentioned, but also bridge financing, which we've seen a lot of in the last couple of years. So we'll likely still see that, but again, we don't want those clients having to stay with us for 2-3 years, because that's when the problems start to rack up.
Is that what you usually do in a scenario like that then? You try and come up with a rate that's basically palatable that they can pay through income and keep the property afloat to try and see to better times?
Yeah, honestly, we luckily haven't had to deal with this a lot in the last couple of years, because the market's been so strong that clients either been able to sell their property, or lenders have seen, a property that we may have had at 70% LTV is now at 55% LTV, and the bank's much more likely to make an exception and take that out, right?
Yeah.
So if that starts going the other way and values are decreasing, obviously we're going to be more challenged there. So I don't know. I'm hopeful that, we're going to see it ease a little bit, but based on what Governor Macklem said last week, it sounds like he wants to keep hammering us over the head with the increased rates.
Yeah. Do you think, banks are going to start calling loans? Do you think there's going to be default issues? Like, what do you foresee there?
I think it's definitely going to increase. So, I'm proud to say that I think we had 0 foreclosures in 2020 and in 2021. And typically, historically, we would see that as a bad thing, that we're not taking enough risk, because in our business, it's bound to happen, right?
Yeah.
Just given the type of business we're
Yeah,
in.
that's interesting.
But typically, we do like to keep that to a low percentage. We've started to see that creep back to historical norms, which is fine.
What are historical norms?
Below 5%. So I'd say
2%.
our target's typically 3 to 4%.
Right.
For foreclosure rates, so significantly higher than the banks would have, but very normal for private lending.
They try to say sub 2%, is it, or even lower than that?
Even lower than
it's
that,
even
like
lower than that.
0.2%.
Yeah.
I think
Oh
is the
wow,
target.
wow. Okay,
Yeah.
so not at all.
Yeah,
Wow.
basically not at all. So
Yeah,
I know they don't want any, but I just assume like
but they still do.
There's a level of risk.
They
that
don't
you
wanna
assume
just
as a business
sprinkle-
that you have
risk
to
with
take
it. They don't
on,
wanna
you
just
know.
sprinkle a couple defaults. For
So,
season.
goddamn.
Yeah, to answer your question, I think definitely, hopefully there's, more flexibility and not as many called loans. Like I said, with us, like we want to avoid that at all cost, and we understand that there's external market forces that are happening here. So as long as the client's kind of holding up their end of the bargain, or, if they're really, not able to make those payments for whatever reason, we come up with a payment arrangement, right, to get them that additional 3 months or 6 months they need to get out.
So, and again, just so people know, when you're saying calling a loan, like there's a couple options I think within that. They're literally wanting to get out of that property and not work on that, be a part of it anymore. So they need to get paid out, and they're usually putting a short term on it, like being like within 180 days or 90 days, even we need you to pay us out to get us out of this property. Or additionally, and I don't know if we've seen this here, but you want to pay down the loan to value. So like we've now reassessed.
Yep.
Rental cash flows are not going to cover this amount of
Yeah,
debt.
you need to put a lump
and so
sum,
now you
yeah.
need to give us another couple $100,000 to reduce this loan, which
That's going to become more common.
this I've talked about it before. It's a scary thing, and just because if you have a bunch of properties that are at a high leverage ratio, and then the loans are all needing to be called, or you need to dump down $100,000 on each of them, and you don't have that available, you could be forced. Your hand could be forced to sell something at potentially not a great number just to literally pay out the loan.
Yeah, that's a great point, Neil. And one thing I didn't mention is that our loans are interest-only loans as well. So typically, if you're paying P&I to us, that means you're on the shit list. So
That's
we typically want to
principal
avoid
plus
that.
interest. Yeah.
Principal plus interest. Thank you. But yeah, I mean, there is scenarios where people do want to pay down principal as well, and it makes sense, and it helps them with the takeout as well if they can pay it down by a little bit.
Okay.
But that's another benefit of our open loans as well, is that people can make those principal payments. Say you get a big bonus or something, or you sell off another piece of real estate and you want to put $50,000 down on the loan.
Yeah.
We can do that, and there's no penalties to do that, and you can do as much or as little as you want in a given year.
Yeah, also not having a principal component of your monthly payment keeps that cash flow similar to if you had an A lender on the deal, which again, if you're going through a project for 6 months, you are most concerned with cash flow. So it could get it closer again to net zero versus going to a primary lender, an A lender.
Could you see yourselves if someone gets, let's say an A lender calls someone's loan, could you see yourselves stepping in to pay out that A lender with another exit strategy, or what would you guys be looking for there?
We've done that before. Are you kind of talking in terms of like saving them from foreclosure?
Yes.
Yeah, we've done that before, but it typically the loan to value has to be in such an area where there's enough equity there where we might be able to build in an interest reserve and cover payments for those 6 months or 12 months.
Yeah,
and we need a pretty locked down exit strategy for something like that. Like we are going to sell the property within this
Well, that's
time
just
frame.
it. If they've got that much like equity in the property, they're really treading water, and the bank's probably like, sell the damn thing.
Exactly.
Right? And they'd come to you, and you'd probably say, yeah, we'll help you out for a period, but then you might have to sell the damn thing 100% to recover this. Yeah.
And that is an acceptable exit strategy for us too. If they're willing to sell the property, and we feel where they're going to price the property makes sense, then we have explored those situations before. But it has to be the right fit, because those are naturally higher risk clients.
Yeah, that makes sense, obviously, because you're basically taking over a failed setup with somebody else, and you're hoping to turn that around. So I was just curious what that looks like. Again, I'm a bit of a fear monger. I'm just concerned about where things are going in this next year. But I don't think I have much else. Like I said, you think you said the rates, you see a couple more hikes this year and staying through to the end of next year. Do you think you'll see more rate hikes next year? Like my opinion, I feel like walking away from Tiff is I feel like there's like 100 plus basis points to go.
Well, man, 100 points is
At
nothing,
least,
though.
if not
At the rate
200.
at the rate we're going, 100 points is nothing.
Chandler lives for massive rate hikes.
No,
He's
I
on
told
all
you the
variable
whole man.
products. a couple 300-400 basis points, whatever for Chandler, but for the rest of us,
Stick it to me.
I think, from my perspective, if I had to guess, and it is complete guess, I think there'll be one more this year, one more next year, and then hopefully we'll start to see it either level off or trend down. Because
You think they'll give us a Christmas break? I was kind of thinking they might give us a Christmas break.
I don't know about
because
that.
they've got a meeting. Well, they've got a meeting at the end of this month, October, and then they've got a meeting. There's nothing in November, and there's one in December as well. I think at a minimum we're going to see 50 points here in a week, right?
I bumped into Tiff at the Halloween store with a Grinch costume, so I think we're getting a big Christmas bonus. Well, he's getting a big Christmas bonus.
Yeah, so I mean, to see 100 points by the end of the year is very, very possible. Very possible.
But I mean, to your point, Chandler, on I think it was a previous episode you guys had where we're not seeing the effects of the past rate increases yet.
This mother
With
won't
the
even give it a
effect of-
chance.
Exactly. And inflation is starting to go down. It's starting to trend down. So rather than I was kind of surprised where he basically told us that it is going to go up again. Because if you guys had asked me this before that, I would have said we're probably done and we're not going to have any more this year.
Listen, by all indications, we're already rolling over, right? So
Hold the
it's
phone.
it's kind of like, you're going up this hill, right? And there's always this lag, and you start putting this downward pressure on it. But when you put the pressure point here, it still continues up for a bit, and then it starts to roll over. So now you're going downhill, and it's like at a certain point when you're going downhill, you can stop pedaling, right? And you can coast down the hill, and he's still pedaling full tilt on his little training wheel bike. I can't stand this
You
man.
want to go after this guy? Let me pause for a second. Remember in the presentation, the one thing I did get from it was when you exclude factors like gas and food,
Core inflation,
and you just look at core inflation, it hasn't moved a ton. And so there's that aspect. The other thing that
Hasn't moved at all.
It hadn't moved at all. It was at 5%. It hadn't moved at all. So that target they're trying to bring down. That's why they're creeping to increase rates. But I do think in time it'll start to move. The other thing, I think, listening to him, it sounded like the focus of the BOC almost is more on, which makes sense, basically the value of our currency.
I didn't take that
Than
from
the
it at all.
actual homeowner. Like at the end of the day, Nancy's not gonna be able to have all the fancy food for Christmas, but if our currency plummets to a value that's worthless, no one's gonna have any nice food for the rest of Christmases.
Yeah,
You know,
I didn't
he
necessarily
kept
take
talking
that
about
from it.
runaway inflation.
My whole thing that I took from it is that he basically said the labor market's too hot.
Totally.
Unemployment's
for
too
runaway
low.
inflation.
Wages are too high. The labor market is still way too hot, and that's the thing. People, and I said this before, and people didn't like it. Until people are unemployed, they're going to keep these raises up. So we were tracking unemployment for a while, and all these layoffs. And again,
It's
you can
shot back
see
down.
those things yes and no, man. You can still hear the whispers of it because those take forever. And we talked about this last episode about unemployment is the last thing to go. The housing market's the first thing to topple, and it toppling is a sign that inflation is cooling, but it just happens so quickly. All the other things, consumer buying, then orders, then profits, then unemployment. So we're somewhere in this downward projection, but he's just still pedaling full tilt.
I don't know. Coming out of that presentation, I'm not feeling super convinced.
No. He's going to raise them. There's no question. But I also think what's really interesting is when this episode drops. I don't know when this episode's going to come out, but shortly, actually, probably as this episode drops, we're going to get the inflation numbers for September, and those are going to be huge. I think it was 7% in August, which was deemed as a win. We need to see that sucker under 7%.
I'm still on the thing.
He's still going to raise it,
core
but
inflation, man, core inflation, because we talked about it. Gas prices are artificially manipulated by just dropping the crap out of the reserves. So eventually those will go back up. It doesn't really mean anything.
But even core inflation has started to level, right? And again, you're talking about this thing as it crescents and then it starts rolling over. You have to look forward, and it's so ironic that they didn't look forward whatsoever when things were going to the moon, right? He was just chilling, and then now he's kind of hasn't learned. But we need to wrap it up.
We let Ryan go.
Yeah.
We also have to go to a meeting.
Yeah, really
But-
appreciate the insight.
Yeah, thanks for
guys.
coming in. Anything else you want to add?
No, nothing in particular. It was a lot of fun. Appreciate you
Yeah,
guys
we'll put
having
all
me
your
on.
details so people can connect with
Absolutely.
you. You guys are even on Instagram. I think you have 2 Instagram accounts because one got hacked or something like that.
I didn't want to mention that, but thanks anyways.
But,
Graysbrook _capital. Stick with that one.
We'll make sure people have your credentials, and obviously people can reach out to us for a small referral fee. We will gladly send
Yeah,
you one.
exactly. Text us direct, and then for 1,000. No, so I want to add in as a last thing. Obviously, thanks for coming in and everything like that. But I do want to say, obviously, Graysbrook's been amazing for me. They've basically got me started. They allowed me to grow a ton. I'm now going through all the exit strategies and cleaning things up. But I also want to add, like we didn't really talk about it, but the service level has been awesome. Like responsiveness.
I didn't realize this episode was sponsored.
Yeah,
Are you charging?
no,
me?
I'm just
Is
doing it
now.
because Ryan's the man. So, and they've always been so responsive, but everybody, all your staff too. Like I send an email and within like 30, 40 minutes, I have an answer, which is so valuable when you're in there and you have all this money out. It's super stressful and you're looking for answers. And if you have to wait 3-4 days or you have to call the bank 5 times to get through, it means nothing. So that's another thing I just want to add in there before we finish up. But
Yeah, speed and service are at the core of our business, so I appreciate the kind words, Neil.
yeah, man.
Cheers.
Awesome. So thanks for coming on.
Thanks again, man. Really
Yeah.
appreciate it.
Any other questions, guys? Leave them in the comments and we'll make
Like,
Ryan answer them in an email.
comment, reach out. You know the deal.
Yeah. Peace.
Thanks so much for watching the episode. I hope you enjoyed it. If you did, press like. Don't forget to subscribe. But also check us out on Instagram and TikTok. You can find all the links below. Thanks again for checking us out.
When I was broke, I had rich habits. When I was broke, I had rich habits.